Welcome, investors. Today, we're diving into the core functions that drive financial stability and compliance within our company, accounting and taxation. To begin, let's explore accounting. This is all about keeping track of our fund, what comes in, what goes out, and where it's going. Moving on to taxation. This helps us manage our finances wisely and avoid any trouble with the tax authorities. Our presentation is structured into two primary segments. Let's commence with Part 1, Vietnamese accounting compliance requirements. Now, let's delve into specific aspects pertinent to our operations in Vietnam. Firstly, let's discuss accounting standards. In Vietnam, we strictly adhere to the Vietnamese accounting standards for our financial reporting. These standards play a crucial role in maintaining consistency and transparency across our financial records. Next, let's address currency. For accounting purposes, we exclusively use the Vietnamese dong as our official currency. This detail is pivotal for precise financial tracking and reporting accuracy. Moving forward, let's touch on audit requirements. Foreign enterprises operating in Vietnam must undergo annual audits conducted by independent auditors. This ensures adherence to regulatory standards and enhances financial credibility. Let's shift our attention to the requirements and components of financial statements in Vietnam. To begin with, financial statements necessitate signatures from legal representatives and chief accountants. For foreign direct investment companies, auditing financial statements is mandatory. Furthermore, these statements must be submitted within 90 days from the conclusion of the fiscal year. Regarding the components of financial statements, they encompass the balance sheet, income statement, cash flow statement, and notes to financial statements. Let's transition to Part 2, Taxation. Now, let's delve into the structural framework of Vietnam's tax system. Within Vietnam's tax landscape, enterprises encounter several taxes that necessitate frequent filing. These include value-added tax, corporate income tax, personal income tax, and foreign contractor tax. Additionally, depending on the nature of the business, other taxes may come into play. Let's now emphasize a critical aspect, the tax report deadlines in Vietnam. For value-added tax, VAT, and personal income tax, PIT, companies are required to submit monthly or quarterly filings. Monthly filings should be submitted by the 20th of the following month, while quarterly filings are due by the last day of the first month of the subsequent quarter. Regarding tax calculations, value-added tax is computed by deducting input tax from output tax, whereas personal income tax utilizes either a flat rate or progressive rate system. Moving on to corporate income tax, CIT, an annual filing is mandated within 3 months of the fiscal year end. This tax is calculated based on the profits accrued during the tax year. Additionally, quarterly prepayments of anticipated corporate income tax, typically around 80% of the actual tax liability, are required. Concerning withholding taxes, payment must be made within 10 days from the payment date to overseas suppliers. Furthermore, companies must settle the annual business license fee by January the 30th, based on the registered capital. It's crucial to highlight that failure to adhere to these tax reporting deadlines may lead to penalties imposed by the Vietnamese tax authorities. Corporate income tax, CIT, often abbreviated as CIT, plays a significant role in taxation for enterprises. Rates: enterprises, whether domestic or foreign, typically encounter a standard corporate income tax rate of 20%. However, companies operating in the oil and gas sector may face higher rates ranging from 32% to 50%. Meanwhile, small and medium enterprises that meet specific criteria can benefit from a reduced rate of 17%. Calculation: when determining the corporate income tax liability, taxable income undergoes adjustments for deductions, carried forward losses, and other applicable adjustments before applying the corporate income tax rate. To qualify as tax-deductible business expenses, expenditures must meet 3 conditions. Additionally, companies can carry forward tax losses for up to 5 consecutive years to offset future taxable income. Key tax incentives include tax holidays and exemptions, granting corporate income tax exemptions starting from the first profitable year or 4th revenue-generating year. Certain sectors like education and healthcare may qualify for reduced corporate income rates ranging from 10% to 17%. These incentives aim to encourage investment and growth in strategic industries. Personal income tax, commonly referred to as PIT, is an essential aspect of taxation for individuals. To determine tax residency in Vietnam, individuals must meet one of the following criteria: residing in Vietnam for 183 days or more within a tax year, holding a permanent residence in Vietnam, which includes having a registered address on a permanent or temporary residence card, or renting a house in Vietnam for 183 days or longer within a tax year without proving tax residency in another country. Resident taxpayers in Vietnam are subject to pay personal income tax on their global employment income, regardless of where the income is received or earned. The tax rates are progressive, ranging from 5% to a maximum of 35%. On the other hand, non-resident taxpayers are subject to personal income tax at a fixed rate of 20% on their income sourced from Vietnam. This ensures equitable taxation based on residency status and income sources within the country. Let's delve into one of Vietnam's most prominent taxes, value-added tax, VAT. Value-added tax is applicable to goods and services used in production, trade, and consumption within Vietnam, irrespective of whether they are procured domestically or from abroad. There are two methods for value-added tax declaration: credit method, also recognized as the deduction method. This approach involves computing value-added tax liabilities by offsetting input value-added tax against output value-added tax. Direct method. This method calculates value-added tax liabilities for specific goods and services, such as gold, silver, and gem trading activities, utilizing predetermined value-added tax rates. The upcoming tables will provide detailed information regarding the rates and calculation methodologies for both the credit method and the direct method of value-added tax in Vietnam. These tables outline the specific VAT rates and their application under both methods, providing clarity on how VAT is calculated for various goods and services in Vietnam. One significant tax worth highlighting is the foreign contractor tax, FCT, also known as withholding tax. Foreign contractor tax is applied to foreign organizations and individuals undertaking business activities or earning income from Vietnam under agreements with Vietnamese parties, including foreign-owned companies. It's important to note that foreign contractor tax is not a standalone tax. Instead, it combines elements of value-added tax and corporate income tax for foreign business entities, or value-added tax and personal income tax for foreign individuals. This integrated approach ensures that taxes are appropriately withheld and accounted for on income derived from Vietnamese sources by foreign entities and individuals. PREMIA TNC Vietnam offers expert guidance on Vietnam's accounting, tax, and regulatory landscapes. Our experts provide insights on compliance standards and strategies for optimization. Get in touch with us for complimentary consultations tailored to your specific regulatory needs. We appreciate you taking the time to learn about our accounting and tax services. Our dedicated team is eager to assist with your operations in Vietnam. We're committed to becoming your trusted business advisor and supporting your success. Let's collaborate and achieve your goals together.